All right, let's dive right in. Stock analysis can feel, well, super complicated. But what if there was a simple framework inspired by one of the best investors ever that could cut right through all that noise? Today, we're going to learn exactly how to do that. Have you ever done this? You look up a stock and you're just hit with this wall of data. PE ratios, EV/EBITDA, ROIC. I mean, all these acronyms can make your head spin. You see the numbers, but the real question is always, how do you find the actual story that's hidden in there? How do you separate what's important from what's just static? Well, that's exactly what we're going to tackle. We're going to build a really simple mental model to make sense of it all. And our guide for decoding this data wall, it's going to be none other than Warren Buffett. Now, we're not going to use his super complex formulas. Instead, we're just going to borrow his basic philosophy, a way of thinking that helps you zero in on what really matters when you're looking at a company. This right here is the heart of it all. Before we even start thinking about the price, we have to ask ourselves, is this a great business? See, Buffett's whole approach is about quality first. Once you figure that out, then, and only then, do you ask if the price is fair. It's a two-step process that brings an incredible amount of clarity. So, to put that idea into practice, we've basically distilled it all down into a simple three-part checklist. Think of this as our special lens for looking at any company's financial data. It's not about knowing every single metric, it's just about asking the right questions. And here they are, three straightforward but really powerful questions. Number one, is it a high-quality business? Number two, does it have low debt? And number three, is it selling for a fair price? And to see how this works in the real world, we're going to apply our Warren Buffett way check to an actual company, the home builder, Lennar Corporation. That's ticker symbol LEN. Okay, let's get into it. Starting with step one, figuring out the quality of the business. We're basically looking for clues in the data that tell us if this company is profitable, efficient, and built to last. And we'll start with one of the most important metrics for that. And that metric is return on equity, or ROE. To put it simply, for every single dollar that shareholders have invested in the company, how much profit does it kick back in a year? A really well-run company is going to have a consistently high ROE. Okay, so looking at the data for Lennar, we see its current ROE is 9.41%. So for every dollar of equity, it's making about 9.5 cents in profit. Now, a number by itself doesn't really tell us much, right? Is that good? Is it bad? The key is always context. And this shows you exactly why that context is so important. When we put the current ROE next to its average for the last 3 years, we can see it used to be way higher, over 14%. So our first clue is this. Lennar is a profitable company, but its profitability has been going down recently. That's a really crucial piece of the story. Now for the second part of our quality check, debt. You can have a fantastic company, but too much debt can absolutely ruin it. The debt-to-equity ratio is a super quick way to check its financial health. It tells you how much the company is relying on borrowed money versus its own. A low number here is a very, very good sign. And would you look at that? Lennar's debt-to-equity is just 0.19. That is incredibly low. It means the company has way more of its own money than it has in debt, which gives it this huge safety cushion and a ton of flexibility. On our quality checklist, this is a massive green flag. Okay, so on quality, we've got a bit of a mixed picture, right? Profitability has been declining, but its finances are rock solid. So now we move on to the third and, let's be honest, the most exciting question. What about the price? Is this potentially great company selling for a fair price? A fantastic place to start looking for value is the price-to-book ratio. This just compares the stock price to the company's net asset value. What's written down in its accounting books. If the company were to sell everything off tomorrow, what would be left for shareholders? A PB ratio that's close to 1 suggests you're not paying a huge premium for those assets. Now, looking at the data, two things jump out. First, Lennar's current PB ratio is a low 1.07, so the stock price is really close to its asset value. But second, it's also lower than its own 3-year average. That suggests that, based on this one metric, the stock is actually cheaper now than it has been recently. Another little check mark for a value investor. But the real test, the ultimate goal in the Buffett playbook, is this idea of the margin of safety. It's all about buying a stock for a lot less than what you think it's actually worth.
That discount is your protection, your buffer, in case you're wrong or something bad happens. It's really the foundation of value investing.
So to figure this out, we need a starting point, and that's the current market price. As of the last market close, you could buy one share of Lennar for $94.81. This is what the market thinks it's worth today. But when we do calculation to estimate the company's real intrinsic value based on its future earnings potential, we get a very different number, $130.02. And that gap, the difference between the price and the value, that's where things get interesting. And that gap is our margin of safety. In this case, it's over 27%. That means the stock is trading at a 27% discount to what we estimate its fair value to be. According to our checklist, this is exactly the kind of potential bargain we want to find. So let's zoom out and put all of our little clues together. We've looked at the business quality, we've looked at debt, and we've looked at the price. So what story is our simple checklist telling us about this company? Well, on the pro side, you have that incredibly low, super safe level of debt. And it looks like there's a significant margin of safety with that 27% discount. But on the con side, that recent drop in profitability is a real concern. And if you dig a little deeper, you see net income has actually fallen pretty sharply. Now, let me be super clear. This is not investment advice. It's just to show you how this framework helps you clearly see both the good and the bad. And honestly, that's the most important thing to take away from this. This framework doesn't spit out a simple yes or no. The whole point is to give you a structured way to think, to build a story, and to understand the trade-offs. It helps you turn that scary wall of data into a story that actually makes sense. So now you have it, a powerful 3-step checklist to cut through all the complexity and focus on what really matters. The next time you see that wall of numbers, you won't feel overwhelmed. You'll know exactly which questions to ask. Thanks for tuning in.